Hello, everyone, and welcome to today's self-directed IRA and solo 401k Q&A session. Before we start here, just want to make sure that everyone can hear me okay. So if that's the case, if some of you can give me a thumbs up, just so I know that my audio is okay, I would appreciate that. But my name is Natalie with Sense Financial, and I just want to encourage you to submit any questions that you have in our Q&A chat area, but we are going to also answer any questions that were submitted ahead of time. I would also like to encourage you to join our next live Q&A session. It's on solo 401k contributions clinic. So it's on December 11th, next Monday. It's at 11 a.m. and it's specifically for any contribution questions. Today, Dmitriy Fomichenko will be answering all of your questions, and he is the president and the founder of Sense Financial, a boutique financial firm that specializes in self-directed retirement accounts with checkbook control. He began his career in financial planning and real estate investing in 2000, and he owns multiple investment properties in various states, and he's a licensed California real estate broker. Dmitry holds a designation of Certified IRA Services Professional from American Bankers Association. And over the years, he's taught hundreds of investment and financial planning seminars and has mentored thousands of investors. So welcome, Dmitry, and thank you for joining us today.
Thanks, Natalie. It's great to be here with you again, and looking forward. Looks like we got a lot of questions, so let's dive in.
Yes, a lot of questions, so let's get started. Our first question is from Chris. We currently have a duplex within our 401k that doesn't have a mortgage and is currently being rented out long term. I understand that if we decide to sell the duplex, then will it be subject to UBIT? Is it possible to do a 1031 exchange for another property, and would that exclude us from paying UBIT? Or because UBIT is not the same thing as capital gains tax, so we would still have to pay the UBIT?
Chris, good question. If you own a property inside of your solo 401k and you wish to sell that, the sale of an investment property, assuming it's you held it for longer than a year, it's not a flip, and it looks like that's what it is. It's been a long-term investment property inside of your 401k. When you sell that property, it's not subject to any taxation because a solo 401k is a qualified retirement plan. It is a tax-deferred retirement vehicle that shelters you from any taxation. So there will be no capital gain taxes. There will be no UBIT taxes either. UBIT stands for Unrelated Business Income Tax. And it is this tax is assessed on any income that is derived from business activity. Long-term rental is not a business activity and will be exempt from any taxation. Now, let me segue a little bit. If you have an IRA, so if this was a question for an IRA, and if you sell a property inside of an IRA that is using leverage, then there will be some UBIT implication, but that's not the case. Again, you have a property that looks like free and clear, then even selling that inside of an IRA will not have any UBIT implications. But if it was financed inside of an IRA, there will be UBIT implications. But capital gain taxes do not apply inside of a retirement account.
Great. Okay, so our next question is from Wayne. Can I borrow against my solo 401k for multiple investment properties?
The question is a little bit unclear. Can you borrow against your solo 401k for multiple investment properties? A solo 401k allows you to take a loan from it, so you can borrow from your 401k, not against it. You cannot use your 401k as a security for any loan. So you can take a participant loan up to $50,000 or 50% of the balance, whichever is less. And that personal loan can be used for anything. Now you're talking about multiple investment properties. If you wish to purchase a property inside of your retirement account, then you can potentially get a loan, you can finance that purchase of property, but it's, again, not going to be against your solo 401k. The loan will be secured by the property that you're buying. So again, question is a little bit unclear, but you can take a participant loan from your 401k up to 50k again, or you can finance purchase of an investment property inside of your 401k. Typically, it has to be non-recourse loan. Typically, they will require 30 to 40% down payment and about 10% reserves. We do have a list of lenders on our website, but Wayne, if you want to maybe expand your question, email me with a little bit more details so I can give you a little bit more accurate answer.
Our next question is from Tasha. I am about to sell a property and will likely not do a 1031 exchange. If I took the profits of the sale and put it directly into my solo 401k, is it subject to capital gains? I am wondering because these accounts are supposed to be tax-free, or maybe the correct term is tax deferred.
Tasha, you're correct. A solo 401k is a tax-deferred retirement vehicle, and the tax-free component applies to Roth component of the solo 401k. So if you have a Roth sub account within your solo 401k, that's going to be tax-free, or qualified distributions will be tax-free on this account. But if you're talking about selling a personal property that you personally own, and you're not going to do 1031 exchange, so that's going to be just a sale. The sale of a personal property will be subject to capital gain taxes, and you unfortunately may not use the gains from the sale to contribute to retirement account. Contributions to your solo 401k can only be made from the self-employed earnings or a salary that you take from your business. It has to be earned income. You can't use proceeds from the sale of an investment property to contribute to a solo 401k. So that's something that you may want to discuss with your CPA and come up with some tax strategies that might be helpful, but solo 401k will not be part of that strategy because you're unable to contribute to 401k proceeds from the sale of an investment.
Okay, our next question is from Rodney. Should I start converting to a Roth 401k or just start taking distributions? And his age is 71.
Rodney, good question. Should you start converting to a Roth or start taking distributions at age 71? And the answer to that, it depends. I don't know the specifics of your situation. You can do both. You can do the Roth conversion in your solo 401k. Every plan that we establish has a Roth provision enabling you to take any portion of your pre-tax funds and convert that to a Roth 401k. Roth conversion is a taxable event, but it will then continue to grow tax-free. And you also can start taking distributions. Again, I don't know the specifics of your situation to tell you what's best for you, but you can do both. So that's, again, probably something that you'd want to discuss with your CPA or perhaps a financial planner. Unfortunately, I'm not able to give you that kind of a guidance.
Okay, next question is from David. I'm asked to provide a personal financial statement from various lenders and others. What's the question seems to be cut off, but any possible thoughts here?
David, yeah, we will need to get a little bit more clarification on your question here. If you ask to provide a personal financial statement and you wish to include 401k in that, it can be done. We do have on the client portal a form where you can that you can use to provide kind of a statement of the 401k, which can be included in your personal financial statement. But I would love to get a little bit more clarification on your question, David. So feel free to email me directly your question. I'll be happy to give you then detailed answer.
Okay, next question is from Gail. What is the deadline to close out the trust? Can I then transfer the trust to a SEP or regular IRA?
Gail, I'm assuming you're asking about closing your solo 401k trust. I need to know a little bit more of the surrounding circumstances. Why do you want to close your solo 401k? Is it because you're no longer self-employed? If that is the case, then you will have to terminate your solo 401k and transfer assets to an IRA or 401k. And once that self-employment activity ceases, then you need to terminate your solo 401k immediately, because solo 401k is a qualified retirement plan that is employer sponsored. So there needs to be a sponsor. If there is no longer a sponsor, then plan needs to be terminated. So again, I'd love to get a little bit more details on your situation, why it is that you wish to close your solo 401k. Is it because you're no longer self-employed or no longer in business or some other reason? If, again, the first, you need to act on this immediately. Otherwise, there is no deadline, really.
Okay, next question is from Shin Yi. Can I use my solo 401k into a syndication focus on buying multiple cash flowing businesses?
Can you use your solo 401k to invest in a syndication which buys cash flowing businesses? Yeah, that is certainly a possibility. You can use your solo 401k to invest in a syndication. What we need to really look into is the underlying business activities, because most syndications, they invest in passive real estate deals like commercial properties, apartment complexes, perhaps industrial development, things like that. All of those are passive investments. But if you're trying to invest in a syndication that buys actual businesses, then what you need to be aware of is that businesses, they produce business income. And if you're part of a syndication that owns a business, again, if it is an active business, not a passive real estate investment, in case of an active business, the business will generate business income, which portion of that will be passed on to you as the one of the limited partners of that syndication, and that may expose you to unrelated business income tax. So that's something that you want to make sure you understand, discuss with your CPA, and see if there is any UBIT implications. And that's important for you to understand before making that investment, because that will obviously affect your ROI.
Okay, our next question is from Jeff. Can I convert an inherited IRA to a self-directed IRA?
Jeff, you absolutely can convert an inherited IRA to a self-directed IRA. In fact, just last week, I assisted one of our clients. He had a solo 401k and also inherited IRA. And we set up an inherited self-directed IRA. One thing that you need to understand is that when you inherit an IRA from anyone other than your spouse, that IRA remains to be in the name of the deceased. So if you inherited that from your parents or your sibling, for example, or somebody else, and again, anyone other than your spouse, it has to be set up as an inherited IRA, because the name of the deceased will be shown as the account holder, and you will be the beneficiary. So you control it, you will take the distributions from it, but it has to be, again, inherited IRA. So it cannot be moved to your existing IRA or your solo 401k. It has to be set up as an inherited self-directed IRA. So absolutely, yes, you can contact our office and let's talk about the specifics for you, Jeff.
Okay, this question is from Jay. I would like to start a car rental business using the funds in my solo 401k. How should I structure?
Well, Jay, retirement funds, specifically if it's a solo 401k, those funds are, the intent is to use those funds to make investments, not to run a business. So if you want to start a car rental business, then you can't use your 401k funds for that because you are you can be personally involved. You're a disqualified person. The only possibility of you using the funds of your solo 401k is by taking a participant loan. You're allowed to take up to $50,000 or 50% of the balance from your solo 401k, whichever is less, as a participant loan. The proceeds from a participant loan can be used in any way. There is a, again, limit how much you can borrow, and the loan needs to be repaid within 5 years, unless it's a loan to be used for a purchase of a primary residence, which can be extended to 15 years. Otherwise, it's a 5-year loan. That's the only way you can use to start a car rental business. But you cannot use your solo 401k funds directly to start a business that you personally going to be running. That's not possible. That will be a prohibited transaction.
Okay, next question is from Donald. Why should I consider a new firm?
Donald, I'm not sure I'm understanding your question. Considering a new firm for what? So I wish you provided a little bit more details, but feel free to email me the surrounding circumstances of your question. New firm for what? So again, I wish I could answer your question, but I don't fully understand that. So we'll have to move on to the next one.
Okay, next question is from Pavan. Is it possible to convert a self-directed IRA to a solo 401k in the future once you have business income?
Absolutely, yes. You can use a self-directed IRA and then convert that to a solo 401k in the future. So if you're not self-employed right now and you just have a self-directed IRA, you can set that up. You can invest that IRA using in various investments, so you can have control over your retirement funds. And then in the future, once you start a business or start generating some sort of self-employment income, which make you eligible for solo 401k, you can set up a self-directed solo 401k at that time, and you can roll over your self-directed IRA into a solo 401k. Remember that Roth IRA cannot be moved to a solo 401k. So as long as it is not a Roth, it's a traditional IRA that can be moved to a solo 401k, just not the Roth. If you do have assets, illiquid, non-traditional assets in your self-directed IRA, those can also be moved into a solo 401k via transfer in kind, or lower in kind in this case. That means that you're not moving cash, you're moving the assets. That's certainly possible. You can do that. And we help a number of clients do just that. So it's a typical scenario.
This question is from Cynthia. Is a self-directed IRA and assets protected from lawsuits since it's a retirement account?
There are certain limitations and certain protections that depends on your state. And so this is an asset protection question that should be directed to your asset protection attorney. I'm not qualified to answer that question. Again, it does vary, those protections vary by the state, and you should check with an attorney about your specific situation.
Okay, this question is from Justin. Can you fund a solo 401k with an IRA? In other words, roll over or transfer from IRA to solo 401k.
You absolutely can fund your solo 401k with a rollover from an IRA. In fact, solo 401k will accept rollovers from any qualified retirement plan with one exception, and that exception is a Roth IRA. IRS does not allow Roth IRA to go into 401k. Roth IRA can only go to another Roth IRA. That's it. But if you have a traditional IRA, SEP IRA, simple IRA, if you have employer-sponsored retirement accounts such as 401k, 403b, 457 pension, some kind of a employee benefits plan, all of those can be moved to a solo 401k. The note about the employer-sponsored plans such as 401k, 457, typically those funds are locked up until you leave the employer or reach a retirement age. So if it is with the current employer, there might be some limitations for you, but if it is with the past employer, you can freely move those funds into a solo 401k.
Okay, this question is from Jane. Is the max 401k and Roth 401k contribution equal to your gross income up to the maximum limit?
The contributions to a solo 401k are based on your self-employed earnings. It's not based on your gross income or adjusted gross income. It is specifically based on your self-employed compensation. Or if you are an incorporated business and you take salary, it's going to be based on the salary that your company pays you. And there are two components on the contributions. You can contribute as an employee, which is employee elective deferrals. The limit for that is $22,500, and it is based on your self-employed compensation or the salary that your company pays you. And that part is up to 100% of your compensation. There is also a catch-up of $7,500 if you're over 50. That brings the limit up to $30,000. And if you are and then on top of that, you can make profit sharing contributions, which is 20 to 25% of your self-employed compensation for a combined maximum of $66,000 or $73,500 for those who are over 50. So great tax shelter. You can contribute quite a bit into this, but it is based on your net self-employed earnings.
Okay, this question is from Nancy. How can one get a property out of a self-directed IRA? Need to use for personal.
If you own a property in your self-directed IRA and you wish to use that personally, it's possible to take that property out of an IRA. The proper term for that will be taken in-kind distribution. In-kind meaning that you're not just taking the cash out, you are taking the asset in kind. So you can take the property out of an IRA as a distribution. The property will need to be appraised. The appraised value will be the taxable amount, and you'll pay the taxes on that, and then you retitle the property to your personal name from the name of the custodian. If it's a self-directed IRA, custodian holds that. If it's a checkbook IRA, then from the LLC that holds the title to your personal name. You got to work with the custodian to document that because it's a taxable event and it's a reportable event. But you absolutely can do that, and we help other clients do just that.
Okay, this question is from Ivan. I am an active duty military who's retiring in spring next year. I'm looking to roll over my TSP.
Ivan, if you're an active duty military who's going to be retiring and you will have access to your TSP, you absolutely can take that account and you can roll that over into a self-directed IRA or 401k, depending on your circumstances, but you certainly will have access to your retirement funds and you can convert them to a self-directed account once you retire. No problems there.
Okay, Andrew is asking, how much can I contribute to my business account?
How much can you contribute to your business account? Well, it will help if you clarified which business account you're referring to. If you're talking about a business account for your retirement, for, let's say, for your solo 401k, trust or for your IRA, contributions to an IRA is limited to $6,500, and you cannot contribute to a business account. You contribute to an IRA. You have to contribute to a custodial account and then transfer that to a business account. If you're using IRA LLC structure, then that will be considered an investment that your IRA makes. If you are self-employed and you have a solo 401k, you can contribute to a solo 401k. Contribution limits to solo 401k are for this year at $66,000. Again, it is based on your net compensation, self-employment compensation, and there are two components. So there are nuances and details that you need to understand, but I'm happy to go over the details with you. And in fact, we're going to be next week, we're going to be talking about specifically about contributions to a solo 401k. So if that applies to you, then tune in next week and we'll spell everything out for you.
Okay, this question is from Sam. What is the tax implication of doing Roth conversion of my solo 401k?
The tax consequences of doing a Roth conversion in your solo 401k are as follow. The amount that you convert to a Roth becomes a taxable event. It is reportable and it is taxable. You have to complete the Roth conversion form and then provide that to us in January, and then we can help you generate a 1099-R. 1099-R will list the amount that of the conversion, and that is something that you will give to your CPA, who will then report that as a taxable income on your personal tax return, and you'll pay taxes on that. But it's going to be based. You'll have to pay ordinary income tax on that. How much depends on your particular situation, depends on your tax bracket. That's something that you gotta discuss with your CPA.
This question is from Fred. How does CI affect solo 401k trust?
How does CI affect your solo 401k trust? I'm not sure what you're referring to. CI, what is that? So I wish you spell that out for us. I'm sorry, Fred, cannot answer that question because I don't understand that, but please get back to us and clarify your question. I'll be more than happy to answer that for you.
Okay, next question is from David. Do you have to file any tax information annually for real estate held in a self-directed IRA?
Before I answer that question, I want to get back to Fred and the previous question, and to, I think, a couple other questions that we had previously that were unclear. You guys have the opportunity to go to the Q&A section, and you can actually expand your question there. So type it there so that Natalie can read it at the end, and hopefully I can understand it now, and we'll give you a clear answer on that. So Fred, please expand on that, and other folks do the same thing. So now getting back to David's question, do you have to file any tax information annually for real estate held in a self-directed IRA? Not specifically for an IRA. You don't have to report your real estate holdings per se in a self-directed IRA. But if it is a checkbook IRA, you have to provide the valuation of the LLC to your IRA custodian. IRA custodian will request that valuation every December. You need to provide the total value of the LLC because they have to do the reporting to the IRS, and that the value of the IRA is based on the value of the LLC because that's the only asset is in an IRA. Now, in addition to that, if you use leverage, if you finance the purchase of a property inside of an IRA, the portion of the income that is derived from the finance portion of the property will be subject to UBIT tax. you will have to report that using a Form 990T. Again, something you'd want to revisit with your CPA. So there will be some reporting requirements. Again, not specifically for the real estate. If you just own real estate free and clear, you don't have to report that to the IRS. But if it is finance, then yes, there will be some implications there.
Okay, question from David. Is it possible to comply with required distributions by transferring ownership shares?
David is asking if it is possible to comply with the required minimum distribution by transferring ownership shares. If you're referring to RMD, then yes, you can do what's called in-kind distribution. You can distribute ownership of your shares and whatever investment that you have from your retirement account to yourself. Again, that's called in-kind distribution. That is possible. You'll have to get a third-party valuation on those shares, and you certainly can do that.
Okay, this question is from Phil. I have a SEP IRA and no longer have Schedule C income. Now it's Schedule E. Can I convert to solo 401k?
If you have a SEP IRA, but you no longer have Schedule C income, which is self-employment income, and you only have Schedule E, you cannot convert to a solo 401k because solo 401k has eligibility requirements. It's designed for those people who are self-employed or own a business without full-time employees. So if you have no Schedule C income, that means you're not self-employed, you will not be eligible for solo 401k. But again, Phil, if you're not a client, or if you want to discuss specifics, there might be some other options for you. Again, the question is a little bit unclear. I obviously don't understand your full situation, full picture here. So let's get on the call and let's chat about the specifics.
The question from Anna. She would like more information on required end of the year paperwork.
Anna, it will be helpful to know what type of account you have so that we can properly guide you. But let me give you some general guidance. If you have an IRA that is set up as a checkbook IRA with LLC that your IRA holds, then you are required to provide the LLC valuation to your custodian. There is a form that you can complete and submit that to your custodian. You got to do that at the end of December. If you're a 401k client, then there are a few requirements that may or may not apply to you. Number one, you have to make certain contributions. Contributions might have a deadline before the end of the year. If there was a taxable event in your retirement account, such as you took out a distribution or you did a Roth conversion, those are reportable events and taxable events. So 1099-R is required to be issued, and the contributions also needs to be reported, although that's not by the end of the year. That will be done next year on your tax return. But we do provide all the guidance. In fact, we do have a guide specifically designed for end of the year requirements. So we actually send out email to all of our clients with those details. Again, some of those items may or may not apply to you. You got to review those items and work on those that are applicable to you. But thank you for the question, Alan. Good question.
Okay, we have some questions that were submitted here in the Q&A chat area. Again, to anyone who's on this webinar today, if you have any additional questions, please feel free to type them up and we will answer them. But this question is from Jay. Roughly what percentage would I pay to the IRS if I was to do an early withdrawal?
If you take early distribution from your retirement account, then early distribution is subject to penalties, federal and possibly state penalties as well, depending on the state you reside in. And then the amount that you take as a distribution will be subject to taxation. What percentage, I cannot answer that. I'm not a CPA and I don't know your situation. So that's something that you would want to discuss with your CPAs based on your tax bracket. So it's impossible for me to give you any kind of a rough estimate there. But again, penalties, 10% state, possibly, 10% federal, possibly state penalties and ordinary income tax.
Okay, a question from Fred. I believe he clarified the question from earlier, but how does FinCEN apply to solo 401k trust?
Fred, thank you for clarifying, but I'm still unclear what FinCEN is. So if you can explain what that is, I don't think I've heard that term before. I don't know everything that there is. I'm learning certain things. That might be something new that I'm going to have to learn, but I'm not sure what FinCEN is. So we'll appreciate if you can clarify that.
Next question here is from David. I have multiple LLCs within my self-directed IRA. Am I able to move checkbook funds / rental income from one LLC to another via writing a check, or must I complete a funds transfer agreement?
You don't need to complete a fund transfer agreement. So, but I'm not sure I can answer your first question there, David. That will be a good phone conversation. It's possible. I think you can, but I want to get a little bit more insight on where you're coming from. I believe you should be able to do that. You can move funds from one asset to another, but again, I need to now that I'm thinking of this again, you might have to go through IRA custodian because I believe you won't be able to do that because the LLCs, they own by the IRA. So you can only you can make distribution from one LLC back to an IRA, and then you can move it to another LLC. So that's how you could possibly move the funds. But I don't believe you're going to be able to move the funds directly between the LLCs.
Another question from David. Am I able to invest in REITs or mortgage funds with money within an LLC in a self-directed IRA? How about stocks from the New York Stock Exchange?
David, you can buy stocks with your self-directed IRA LLC, but in order to do so, you can't use your checking account, obviously. You will need a brokerage account. So you'll have to open a brokerage account in the name of the LLC, and you can use brokerage account then to buy stocks or mutual funds. If you wish to use your funds to invest in a REIT or a mortgage fund, you absolutely can do that. The investment entity will be the LLC. As a manager, you control the LLC, so you can direct those funds into a mortgage fund. Many of our clients have done it, and you can do the same.
Question from David. What's the difference between solo 401k and self-directed IRA?
Self-directed IRA is an individual retirement account. Anyone can have it. A solo 401k is an employer-sponsored plan. It's not for everyone, unlike an IRA. to qualify for a solo 401k, you must be self-employed or own a business without full-time employees. But there are a few other differences, but that's the main difference is the eligibility requirements. If you are eligible, if you qualify for a solo 401k, meaning that you're self-employed or own a business without full-time employees, then you can set up a solo 401k. And solo 401k has several major advantages over an IRA. So it is a better option. One of those distinctions is the contribution limits is almost 10 times higher than an IRA. A solo 401k is exempt from the UBIT tax on leveraged real estate. You can take a loan from your solo 401k. You can have Roth sub account within your solo 401k. So those are some of the major differences.
Okay, a question from Gabby. In January 2023, I rolled over 250K from Fidelity into my solo 401k. Then I invested 100K in a syndication. What is the paperwork I have to file with the IRS and by when? And do I need to file anything else with the IRS?
So just based on your question, Gabby, if you invested, if you rolled over funds from Fidelity IRA to your solo 401k, Fidelity will issue 1099-R reporting that rollover. So you're going to receive that 1099-R. It should have the correct code that is a direct rollover, so no tax consequences. That's Fidelity's responsibility, not your responsibility. You made the investment into syndication. Again, that particular action doesn't require any specific paperwork. But if you haven't made any contributions, you won't have to report that on your tax return. But what you will be required to do is to file annual Form 5500 EZ. This is a form that is required to be filed by the plan administrator, which is yourself, for a plan that have $250,000 or more in plan assets. So it looks like you're exceeding that threshold, and you will be required to file that. The deadline for that form is end of the 7th month following the end of the plan year. So for most people, the end of the plan year is December 31st. Which means that the deadline for the Form 5500 EZ will be end of July. We do send out a couple of reminders about this deadline, and it's pretty simple and straightforward form to file, so be sure not to miss that. Penalties for failing to file are very severe. I believe it's up to $150,000. Because they really nail you on that. So be sure to set a reminder to yourself because you as the plan administrator are responsible for filing this form.
A question from David. Can I have shares in an LLC personally and with a solo 401k?
It's possible, but it depends. We need to look into a little bit more details what that LLC is. Again, if it's like a personal LLC, then probably the answer is no. But if it's some large investment that you're possibly investing personally and also wish to invest using your solo 401k funds, if you don't have any control or any other interest in that LLC, then it's possible to invest. It's just like buying shares of an Apple with your solo 401k and also personally. You can do that. You possibly can do it into an LLC as well, but we need a little bit more details to accurately answer that question.
A question from Fred. Can a company that collects rent on our properties contribute to our Roth? And would this be taxable to me? Now, the rent is not subject to Social Security tax. If the country contributed to the Roth, would it have to pay Social Security tax?
Um, can a can a company that collects your rents on your properties? I'm assuming those are your personal properties. No, the property management company cannot contribute to a Roth IRA for you. You can contribute to a Roth IRA, and you can't use the rental income to contribute to a Roth IRA. You have to have other earned income in order to be able to contribute. But your property management company cannot contribute on your behalf, so that's not possible.
A question from David. With regard to the personal financial statement, I was wondering how one evaluates holdings within the self-directed 401k for investments such as LP in an apartment syndication and private money lending.
Well, how do you value for a personal financial statement, how do you value the investments? If it is private money lending, then you have a note. Note has a value, so I think that's pretty straightforward. If you're talking about apartment syndication, those syndications will give you a K1, which will show you the value of your share. So that also should be pretty straightforward. You can use those numbers.
We have a question from Anna. How is the value of 401k calculated? Is this the total amount of contributions or total amount of money on 401k account? In case there were expenses for managing real estate properties inside the 401k.
Anna, the value of the 401k is required for year-end reporting. In case of a solo 401k, there is a 5500 EZ form that is required to be filed, and you have to calculate the value as of the end of the plan year. It's not the expenses that you need to calculate, it's not the income, but it's the total plan assets. So how do you calculate the total plan assets? We do have an article that explains that, but let me make that simple for you. On December 31st, you're going to look what are the assets in your solo 401k. You may have property 1, it has certain value. You may have property 2, it has another certain value. You might have some cash in your accounts, so you get those values, and then you may have maybe a private loan. You get that value. So you add everything up. Those are because you have to value the assets. So you take all the assets, you value them individually, you add them all up, including all the cash, because the checking account, that's an asset as well of the 401k. So you add all them up and you do report the total. That's going to be the total value of the 401k.
We did get a clarification from Fred. So he did mention that FinCEN is the new forced reporting of beginning January 2024, in case that clears anything up.
Well, thanks for clarifying that, Fred. I'll have to look into that. Again, I'm not familiar with that, so I have to read up on this before I can make any comment.
Okay, and then we do have a question from Anna. Can I transfer 401k funds into an annuity?
Well, 401k funds those are qualified retirement plan, and you can move from one qualified retirement account to another. An annuity in and of itself is not a qualified retirement plan. An annuity can be inside of an IRA, so if you're terminating your solo 401k, you can possibly move funds into a qualified annuity. Maybe that's what you're asking. Which is an annuity that is inside of an IRA. That's what qualified annuity is. But you can transfer it to a personal annuity, only to qualified annuity, meaning it's another retirement account.
Okay, well, those were all the questions. So this concludes our session today. Thank you, everyone, for joining us and for submitting a lot of questions and asking a lot of questions. As a reminder, our next session is going to be next Monday, December 11th. It's a contributions clinic. So if you have any questions regarding solo 401k contributions, please join us. We look forward to you asking any questions and hope to see you then. And I hope all of you have a wonderful day.
Thank you for joining us. Lots of great, intelligent questions. I enjoyed answering them. And just to emphasize what Natalie said, especially this time of the year, we do get a lot of questions from our solo 401k clients that are specific to contributions. So we decided to put a special session for you guys where Mina and I will join you and we'll ask specific questions that are related to solo 401k year-end contributions. Looking forward to seeing you then, and have a great day.